In March 2020, the COVID pandemic hit the global economy. The crypto market sold off sharply, triggering $1.2 billion in liquidations within 24 hours before eventually recovering. In November 2022, the collapse of FTX caused another major drawdown. Roughly $1.6 billion in leverage positions were liquidated in a single day, followed once again by a full recovery. In February 2025, Donald Trump began signaling plans to impose tariffs on nearly every country. Cryptos dropped aggressively, leading to $2.2 billion in liquidations within 24 hours before seeing a full rebound. The crypto market loves to bottom on big headlines. Right at the moment when investors are fully convinced that the stars are aligned for cryptos to move lower, that is often the moment where the market begins to recover. Just last week, Trump threatened to raise tariffs on Chinese imports by an additional 100%. That move reignited concerns of a renewed trade war between the world's two largest economies, which immediately led to a massive sell-off in the crypto market, triggering $19.3 billion in liquidations within 24 hours. This was the largest liquidation event in the history of cryptos, more than 10 times the size of liquidations seen during the FTX collapse. As a result, 1.6 million traders saw their portfolios completely wiped out. Following the decline, mainstream media outlets have been quick to call for a bear market, warning that there's much more pain to come for the crypto market in the months ahead. But to evaluate whether that outcome is likely, we first need to understand what made this particular correction so severe. If we compare the performance of tokens that have leverage trading available versus those that don't, an interesting pattern emerges. Take Uniswap and Render, for example. Both of these tokens can be traded with leverage ranging anywhere from 2x to as high as 100x. In simple terms, that means traders can borrow up to 100 times their capital to amplify their position size. During the recent leverage cascade, both Uniswap and Render saw flash crashes of nearly 80 to 90%. That kind of extreme volatility reflects how quickly leverage positions are forced to unwind once prices start going in the opposite direction. Now compare that to coins like Nexo and Origin Trail, which don't have any leverage options available on major exchanges. Both of them declined by less than 15% during the recent drawdown. This shows that the recent correction following Trump's tariff threat wasn't driven by panic selling alone. It was significantly influenced by one major factor: leverage. Leverage allows traders to borrow additional capital to increase their position size. For example, a trader using 10 times leverage can control a $10,000 position with only $1,000 of their own capital. So when the price goes up, the trader makes 10 times more in the process. But that same leverage also works in reverse. If the asset falls by just 10%, the trader's entire position gets liquidated.